How many of you panic during stock market crashes and you do exactly opposite of what it takes to make wealth? How many of you have started your systematic investment plans, but slowly you remove that SIPs, your systematic investment plans? Have you ever given a thought about it? Hi, this is Anirudh Bellare here. Welcome to the 25th video of Your Best Financial Life. In today's video, you will be learning the 5 important steps when it comes to your investments in your systematic investment plans. And I will also be telling you whether you should go for a lump sum investment or your systematic investment plans depending on your age. Let's move on to the first point. Your first point now see what have I written here? Global turmoil, stay invested. See, understand when it comes to the stock markets, just you think. What do I mean by you think? See, there are a lot of people who trade in these stock markets every single day. And understand when it comes to stock markets, the news is very important on what is happening globally. If you see, there are a lot of geopolitical events which are happening, which makes the stock markets very uncomfortable, uncertain. Now, when it is the time of uncertainty and a lot of uncomfortability, you need to understand that this is the perfect time you can give your money the perfect shape for your growth. Now, how do I mean by your money and your growth? See, understand, have you ever got this thought? 1% people have 99% of people's wealth. Isn't it very shocking that 99% of people who live, they either struggle to earn money or it takes a lot of time for them to make wealth. But how is it that this 1% of people have cracked the code on knowing what the 99% people don't do? Do you know the reason? The reason is solely because of the mindset. Because your brain is the most important factor when it comes to your investments. And why do I say so? See, when you invest, you have a lot of emotions when you place your money in that particular mutual fund or stock. Why do you have a lot of emotions? Because you want that money to grow. You don't want it to get eradicated. And that is the sole point. Here, when it comes to global turmoil in the stock market, you need to understand that all these problems keep coming and going. If you would have noticed, whether it is the 2008 financial crisis, your dot-com bubble financial crisis, or your COVID, these 3 instances were the basic and most important understanding of the rebounds of how the stock markets and the economy works. See, understand when there is a major crash like this. Now, what is a crash? If your stock markets go below anywhere 30% or more, it is considered as a crash in the stock markets. Now, see, when these type of crashes occur, you usually have a downfall like this. Now, why does this downfall come? It is predominantly because of the issue which is causing this problem. And when you keep investing your SIPs at different points, when there is the reversal in your markets is when you see your growth in your systematic investment plans or in your investments, which will go up to a very high level. And that is what I want for you. And understand, for people who enter the 1% club, they are always greedy when normal people are fearful. Now, what do I mean by this? See, if you do what any normal person does, you will get the same result of what normal people get. But if you do something which only 1% of people do, you will also get the result of what 1% people do. Now, why am I giving you all these talks over here? See, I have been doing this for my life and I know this is perfectly applicable for you. Why? Because I've seen it with my own eyes. And that is where this understanding of 99% and 1% becomes very important when you stay invested. And that is why I keep repeating this point. If you stay greedy when others are fearful, that will be the biggest time where you will see your wealth rebounding and making money work so hard for your money that it makes your money life and financial life very, very awesome. Let's move on to the second point. Now, your second point becomes very interesting. See, if you don't track your investments on a daily basis, see, why have I put this cross on daily and tick on monthly? See, understand, we all are human beings. We all have a lot of emotions. And understand, if you keep opening your investment portfolio on a daily basis, your brain cannot or will not have the capability to see either losses, because your brain is always tuned to see good things, which is your profits. And see, there are times when you cannot do anything about it, but you need to understand that remaining invested in the stock market, whether it's any mutual fund or whichever stock, after you have done your research, becomes very important. Now, why am I telling you this? See, understand, I'm not a financial advisor over here. Whatever I'm telling you is out of my experience of whatever I've been doing in the past 4 years. See, understand, all these small points, you may think it is very basic, but understand, the mindset and these points together will frame your wealth, which will be seen in your portfolio, and that is what I want for you. See, if you keep opening your portfolio of your investments on a daily basis, as I mentioned, it will cause a lot of irritation to your brain. Why do you require all that? The moment you have clarity of why are you investing in the first place, and what are you going to do with that money when it reaches that certain particular amount, that is where you will not be interested in seeing what is actually happening in your portfolio. And if you still want to see how is the progress of whether your money is making money or it's going in losses, you can obviously have a look at the monthly. What is this monthly? On a monthly basis, you can open your portfolio and see, okay, this is the result. Or you can write down. Suppose you have invested 20,000 rupees. In the second month, that 20,000 rupees has become 19,900. Write it down. On a 1 year period, you can notice how your money has fluctuated during the volatility. And in the sheer long run, what do I mean by long run? Anything above 10 plus years. It is but natural that your money will make money and it will eventually work out for you. Now see, after 10 years, you don't know what is going to happen. Either another correction is going to come or a crash is going to come or whatever is going to come. But always remember one thing. Whenever there is a big correction, which I mentioned, the 30% correction, there will always be a bounce back. Why? Because the economy in which we live is always going to do well. Understand it. As we are a growing economy, I mean, I'm talking about India, we all are a growing economy. It becomes very important that you stay invested because it will eventually help your future. Let's move on to the third point. The third point is the reason why I'm writing this in red in color. Never stop your SIPs. Now, as I mentioned in the previous point, see, if you check your portfolio on a daily basis, it creates a lot of panic. And the whole point of you investing in the stock market is so that you sleep peacefully at night and you make money, work on your money. But understand, if you stop your SIPs, your systematic investment plans, on any particular day, which is lesser than the long run unit, you know what will happen? You need to pay taxes in the first place. Second thing, you need to pay your expense ratio and a lot of other charges. And if your goal itself is not met, the reason why you invested in the first place, that is the most worst feeling, and that is what I don't want for you. And that is why I emphasize saying, when you have put that corpus of money on a SIP basis. Now this SIP basis, I'll give you a very nice and easy example. This is nothing but a bucket, obviously you'll be knowing, and this is the second bucket. Now in SIPs, what happens, every month or every particular week or whatever duration you take, say every month you put one 500 rupee note, just as an example. Now month on month you keep putting this 500 rupee note. After a point, this bucket will be filled with 500 rupee notes. But in lump sum, now what is lump sum? A pool of collection of funds. Now this collection of funds, at one shot you put it, and this is all your 500 rupee notes. Now what happens is, for anyone who is new into investing, if they use the SIP method, which is their systematic investment plans, understand, to see your 500 rupees becoming a 470 rupees is not that much of a big problem in the brain, because just a 30% loss, right? I mean, not 30%, 30 rupee gone. But understand, the more you see your 500 rupees falling, is the more you will get that mental courage to ensure that when this 500 rupees is up to 550 rupees, it will give you a lot of satisfaction. Now see, I have taken the example of 500, but if the amount is somewhere around 5 lakhs and you're a new investor, if you see it falling to 4 lakh 10,000 rupees, see, whatever you do, eventually you should be able to sleep peacefully at night. Why? Because I don't want this tension to affect your day-to-day life, and that is the sole purpose I'm making this video. See, for those who are experienced investors, they can go with lump sum. Now suppose if somebody already has 2 lakh rupees with them and they know how the stock market works and they are mentally strong, knowing how to control their emotions, they can put that 2 lakh rupees, and even if they see that 2 lakh rupees becoming 1,70,000 rupees, it's okay, because they know the more the market corrects itself, the more their amount falls is when the pullback happens, is when your actual money is made. But nobody can predict all this. So understand, you need to go step by step, and if you're mentally strong, you can go the lump sum way. And that is why I say never stop your SIPs unless your goal is met, or the purpose of why you are investing in the first place. Very important point. Let's move on to the fourth point. Now the fourth point is patience beats reactive trading. Now what is this patience beats reactive trading? See, understand, at times as a human you may feel that, you know what, this particular crash, like example the COVID crash or whatever is going to happen in the future, it is extremely painful for my portfolio and I feel like removing it. Why do you feel like removing it, your amount? Because you're not able to withstand the emotion and the pain of seeing that money falling as in going into negative, which is your losses on your mobile screen, not when you have withdrawn the money, on the mobile screen. And understand, as a result, what happens? You book losses, which is a very, very big problem. And understand, then you may come out with conclusions saying there is no point of doing SIPs, your systematic investment plans, or your lump sums, because it doesn't make sense, right? Because unless you see your money working on money, you will feel all of this is a big scam. But understand, see, wealth is not made overnight, my friend. Understand this. For you to earn that money and make it grow, it is an art. See, earning money is the biggest art. The second biggest art is managing your money. Because whatever you earn, if you don't know how to manage it, you will eventually lie up in debt. And the third one, if you don't know how to make your money work on money, you're not the biggest artist, my friend. So usually people work on the earning part, which is the first step. The most important step which I can term for you is the managing part, which is the second one I meant. And the third one is the making money on money, which is the investing part. Now see, in my videos, I generally talk about the investing part, but understand the managing part is very crucial. Why? If you don't know how to manage your finances based on your current living scenario and your lifestyle, it is going to be eventually difficult. There are a lot of millionaires who have still gone into debt traps even though they have earned a lot. And why does this happen? Because there is no proper money management system. And that is the sole reason, also another reason why I come up and show up every Wednesday and Sunday at 8 p.m. for you to understand these concepts, because I don't want you to end up in that debt even though you earn a lot of money. And that is why I emphasize that stay patient. What will happen in 5 years if you have not seen your amount grown? It's okay. In that 5 years, if you have not seen your amount grown in your SIPs, there will be 1 year where all the 5 years of effort will come in that 1 year. That's why it is always said, decades, there are days when decades happen, and there are decades when days happen. See, understand, I have told you this in the previous concepts as well. There are times when in 10 years you won't see any growth, and there will be that 1 year where you'll see all the 10 years growth. This is what I emphasize for you. And this is what actually happens when it comes to being consistent on example YouTube, or being consistent on your mutual fund or your stock. But remember, all this must be done after your financial advisor, after you take the inputs. And that is why I emphasize the point again and again. Let's move on to the fifth point. Your next point, you need to understand this one fact over here. Depending on your age group, right now, today's day, whatever age you are, suppose say, right now, I'm 23 years old. I'm just giving a random example. I'm not 23 years old. I'm just giving an example. 23 years old, and my particular plan from investments is to have a, say, a round of figure of 40 lakh corpus, okay? Say a 40 lakh corpus, which is a very, very big amount. Now to reach this 40 lakh corpus, see, in my particular age, if I am a beginner in investments, I will go with SIPs, as I mentioned in the previous point. But if I'm a professional investor, especially knowing how the stock market behaves, I then go for lump sums as well. And understand, if you do understand that why 1% of people make the 99% of wealth, it is all because they invest and they are greedy when others are fearful. Now see, I have not told you this, but there is this website called Ticker Tape which I use. I'm writing it here. Now in this Ticker Tape website on Google, when you go, moment you open this website, there is something called Market Mood Index. Now what is this Market Mood Index? You will get to know what is the emotion which is going on in the stock market, whether it is greed or whether it is fear. Right now when I'm shooting this video, it says extreme fear. Why extreme fear? Because there is a lot of panic because of geopolitical tensions. And now when this video of mine will be launched on April, things might have cooled down or whatever. But understand, this Ticker Tape gives you a fine idea. This is not a promotion of any website. This is what I use. It gives you a fine understanding of what is the emotion in the market. And understand, When you do your lump sums, especially at the time when there is extreme fear, like right now, and you keep being patient, knowing that it's okay if this 1000 rupees becomes 990 rupees for some time. And if you see your portfolio once a month, or you don't even feel like seeing it, very good. There will be a time in your future you will be extremely rewarded for all your patience you have done at this 23-year-old. See, if currently your age must be 40 or 50, then I don't recommend you doing SIPs. I would directly recommend you doing lump sums. Because it solely depends on why you're doing. See, when you're near to your retirement age, things need to be changed. And when you're farther from your retirement age, things need to be evolved and changed. And that is why I emphasize and mention this concept again and again for you. And see, understand it is during the volatility. Now, what is volatility? Volatility is nothing but uncertainty. You don't know what is happening. The market doesn't know what is happening. And that is when most of the wealth is made in long term. When it comes to lump sum or SIPs, whether you invest here, on whatever dates you choose, as I mentioned, there are days when decades happen, and that is the most important concept, even in life. I mean, there are decades when days happen, and whatever. In that one particular week or one particular month, the effort you have put investing, whether it is your personal life or in your investments, that 10 years of effort will show in that 1 month or that 10 days. And that is what is the most beautiful aspect of compounding, which I wanted to share with you. See, whenever human beings go through their depression phase, or when they feel lost, and when they come back strong from that situation, is where the most growth is attained. And that is why it is important you always keep learning from your mistakes. See, you can watch many other YouTube videos telling the same concept. But I feel the more you learn, the more you hear about, and the more awareness you get about your investments, and the more you see yourself in that situation, it will be the most beneficial for you. And that is what I want for you. Thank you so much for giving your time and watching this 20-minute video, because I know it will eventually benefit you in your future. And I will be talking more about the managing concepts of money. And right now it is the investing concept, because there is a phase. There is every phase. First you have the earning stage, then the managing stage, and then your compounding stage. Now all three stages are important. So I will teach accordingly. Thank you so much once again. If you do like this video, you can do share it with a lot of friends and people who are really interested in this concept, because I feel the value I have given you will eventually help you for your life, and that is what I want for you. Thank you so much.